So there's this really fascinating, almost bizarre conflict playing out in the economy right now. On one hand, you've got CEOs from premium brands, like American Express, and they are painting this incredibly sunny picture. They're talking record growth, a super resilient high-end consumer, someone who's totally immune to what's going on. But then, on the other hand, there's this massive flashing red light on basically every street corner in America, the gas pump. And the data coming from that pump, well, it's telling a completely different and frankly pretty terrifying story. So how can both of these things be true at the same time? Let's unpack it. All right, let's start with the official story, the one you always hear on the earnings calls. I call it the bright skies narrative. You have American Express, which is really the bellwether for the premium consumer, right? And they're telling investors everything is just fantastic. Spending is strong, they're pulling in a record number of new, younger customers. The whole growth engine is just humming along. You hear this and you'd think the economy was just booming for absolutely everyone. But then, this happens. We get a piece of data from April 2026 that just completely shatters that rosy picture. It comes from the University of Michigan's Consumer Sentiment Survey. Now, for decades, this thing has been the gold standard for measuring how optimistic or pessimistic people feel about their own finances and the economy. And the number is 47.6. I know, on its own, that probably doesn't sound like much. But in economic terms, believe me, this isn't just a number. It's a bombshell. Let's be crystal clear about what this number actually means. This is the absolute lowest that consumer confidence has been since the survey started 74 years ago. It's lower than the absolute darkest days of the 2008 global financial meltdown. It's even lower than the peak of the COVID-19 pandemic shutdowns. So this isn't just a dip, okay? It's a total and utter collapse of economic morale. So this brings us to our first really big question. How does this even make sense? Why doesn't the math add up? How can these huge companies be posting record numbers while the average person's confidence is hitting rock bottom? Let's dig in. So, what's the trigger here? What's the one thing so powerful, so psychologically potent that it could just erase all that optimism? What could plunge the American consumer into a deeper despair than they even felt during the Great Recession? And right here, the conflict becomes just crystal clear. For real people, the real world is sentiment hitting a record low, gas prices spiking over 21% in a single month, and the fear of inflation just climbing and climbing. And yet, for a company like American Express, it's just another great quarter with 8% revenue growth. It's like they're operating in two totally different universes. The cause and effect here is just unmistakable. As gas prices shot up, consumer sentiment absolutely plummeted. It's powerful, it's immediate, and it's an inverse relationship. There's really nothing that hits the consumer's psyche quite like the price of gas. It's that daily, unavoidable reminder of inflation that you just can't ignore every time you drive somewhere. And this isn't just another up and down economic cycle. We are witnessing the widest gap, the widest ever, between gas prices and consumer sentiment. This is what the data calls a psychological breaching point. Think about it. For decades, consumers have weathered inflation, but this specific combination, a super fragile psyche meeting a massive, highly visible price shock right at the pump, well, it's created a breaking point that we've just never seen before. But, if this breaking point is so obvious in the data, why aren't alarms just blaring on Wall Street? Well, it's because so many investors and even CEOs are caught in what we call the indicator trap. They're looking at the wrong signals. They're totally focused on what has already happened, not what's about to happen. Okay, so this is super important. There are two kinds of economic indicators. You've got lagging indicators, things like past travel bookings or last quarter's corporate earnings. They tell you where you've been. It's kind of like trying to drive while looking only in the rearview mirror. Then you have leading indicators like gas prices or consumer sentiment. These are predictive. They're your windshield. They tell you what's coming up ahead. The trap is believing that rearview mirror is a reliable guide for the road you're actually on. So let's apply this to the puzzle we're solving. That gas price spike and the sentiment crash, those are our powerful leading indicators. And historically, a sentiment score this low predicts a really sharp slowdown in spending over the next 3 to 6 months. Meanwhile, those strong American Express card fees and all those record travel bookings, total lagging indicators. They reflect decisions people made and money they spent back in 2025, when everyone felt pretty good. They have almost zero predictive value for what happens next. So let's just deconstruct that whole American Express story for a second. That record $10 billion in card fees, yeah, that's from pricing they set back in 2025. That 10% growth, that's just momentum from last year carrying over.
And their big focus on younger millennial and Gen Z customers, well, that actually makes them more vulnerable because those are the exact people most exposed to rising rent and energy costs. Every single one of these strong metrics is just a story about the past.
And this really is the bottom line. The brutal truth of it is that the company's current strength is just an echo of past success. They are literally reporting on how well their marketing campaigns from last year worked, while the leading indicators, the ones that actually predict next year's results, are flashing red alert.
Now, if this whole dynamic of confident CEOs and crumbling consumer data feels a little bit like déjà vu, well, that's because it is. We have seen this exact movie play out before, and it serves as a massive warning. So let's take a look at the historical precedent from the 2008 financial crisis. Okay, check this out. In early 2008, crude oil prices spiked like crazy, up towards $150 a barrel. By the middle of the year, CEOs were all over TV, claiming stable fundamentals and talking about the resilient consumer. Sound familiar? But then the lagging indicators finally caught up to the leading ones. Sentiment crashed, demand just vanished, and the market collapsed. That CEO optimism was the very last, fragile stage right before the floor fell out. So let's do a direct comparison. And this is where it gets genuinely alarming. In both cases, the driver is a geopolitical oil shock. In both cases, the CEO narrative is all about resilience. But look at the crucial difference. The absolute low point for consumer sentiment in 2008 was around 55. Today, it has crashed to 47.6. The consumer's psychological state is significantly worse right now than it was even during the Great Financial Crisis. And this is what just debunks that central myth. The whole idea that the premium consumer is somehow shielded from all this was proven completely false in 2008. They weren't immune then, and with confidence now at a 74-year low, the data strongly suggests they are even more exposed to this shock today. Okay, so given this really stark economic picture, where does that leave investors? Well, this is where we can find a potential opportunity. It's what investors call the alpha. It's all about anticipating this economic shift and knowing where to move your money next. And the strategy is called the defensive rotation. Sector rotation is a really fundamental strategy. It's this simple idea that smart money doesn't just sit still. It moves because it's anticipating what's coming next. So when the data starts to suggest a downturn is on the horizon, investors rotate out of those high-flying aggressive sectors and into what we call defensive sectors, the ones that can weather the storm. The two key sectors to understand here are consumer discretionary versus consumer staples. Discretionary stocks, these are things people want. Luxury goods, new cars, travel. They do awesome in a booming economy. But staples are things people need. Food, toothpaste, medicine. We're talking about companies like Walmart, Costco, Procter & Gamble. And these perform well in downturns because, well, people have to buy their products no matter what's happening. So this number, 1.20, it's a ratio. It represents the price of the discretionary sector compared to the price of the staples sector. When this ratio gets high, it means the market is way too optimistic, betting way too heavily on wants over needs. It shows that investors have bid up the price of those discretionary stocks to a really dangerous premium over the stable, essential ones. And guess what? The last time we saw an imbalance this extreme was right before the 2008 crash. So why even consider staples right now? Well, because in an environment of record low confidence, these stocks act like a stabilizer for your portfolio. They're way less volatile, they tend to pay a higher dividend, and their business model is just dead simple. People do not stop buying soap and cereal in a recession. And given how extremely overweight the market has become in those discretionary stocks, a rotation back to these defensive names could be a hedge against the very downturn that consumer sentiment is screaming is on its way.
When it's all said and done, it all comes back to this. The $4 gas pump is the great equalizer. It doesn't care if you have a platinum card or a debit card. It is a recurring, highly visible psychological tax that just chips away at the confidence and the budget of every single consumer, from the aspirational all the way to the affluent. And CEOs can't market their way out of that reality.
So what you're left with is this. You have the optimistic story from corporate leadership on one side, and you have 74 years of hard historical data on the other. When a comforting narrative and cold, hard data are in direct conflict, which one are you going to bet on?